They all fell. There's not one that doesn't. I can prove it. I already have proved it. And how are you going to plan for it? And what does that look like in your life? That's the important thing. If you're involved in capitalism, you're involved in financial markets, the risks are higher than any other period of time in history right now, in my view. Having said that, is that because of that risk is higher than any other time, is that eventually there's a consequence to that risk. When we look at where the neckline was, we take a look at this piece of the chart, and we take a look over here where that downtrend started in 2008, and the top of that was the first bout. Then, of course, you manipulated it up, and then, oh my goodness sakes, the truth had caught up. And basically, the bull, what it says on the chart is extremely bullish. And we can see that on the S&P that the last highs were right around 1370. But look at the double month correction. And when we hit that 10-month moving average, we bounce like a rocket. There's a lot of uncertainty around the world right now. Yeah, earnings are good. The stimuluses have been working. All of those things have been working. But there's a consequence. And there's a failure point at some point. And as we take them up, the thing that we're really monitoring in this calendar year of 2011 was that each big sell-off that we called for, this one here, and down to the bottoms right here, is that because of the monthly buy signals, is where every dip will be bought in the cycle. Because you can't ignore that. I can say, though, that we're at 91.66% DS on a monthly level on the S&P. And that we could easily break above here. Now, I'm going to go to the SMF platform. And I'm going to pull up a daily chart in our platform. And I can get where the S&P is going to go. We're right back up here. So it's much more visible and an easier way to comprehend. And the thing about the S&P was that we called for a rally that could go up to 1360. That's two full deltas. We're 18.30 from hitting that price to delta right now in our system. And when we get up there, what's going to happen is we're going to be extremely overbought on the S&P. Again, just like we were when May started. However, we could fail if the United States government doesn't know how to work its system correctly, is that these things can fail. And we can see over here at 1365 where that failure was. We called it right here. That was on 5-2. Look at how far down it went. Look at how far it's come back up. There's mathematical negative consequences this way, and there's positive mathematical outcomes that happen this way. But when we do finally reach our destination, what is going to happen then? We're going to sell off. I'm telling you today on 7/23 of 2011 that the S&P 500, as it levers itself back up, and it's bullish chart patterns. I just showed you behind here what this one looks like. That's okay. I'm just interpreting that for standard public technical analysis. Over here, though, is the SMF platform. And what does the platform really say? Is that every indicator that is over here and what is happening is built in here. This platform. And makes it easier for people to understand. What's going to happen is, as we lever back up, we said 1360 on the S&P from this bottom here, this last bottom right here, which was just not too far ago. It was only 1, 2, 3, 4. Today, that's 5 days. The last 5-day trading range is that we got overbought and we came down, like I said, and then we've come right back up to where that reversal happened right here. And when I look at our system, when we do get here, it's time to be looking at this side of the market. And what is this side of the market? Well, short term, long term. Long term could be going out a long ways. I mean, we could go out to 2013, the end in calendar year. We can go out to 2013 here, but we can also go to 2012 here. And when we look at short-term imbalances, mathematical imbalances of overbought and oversold conditions, is that we certainly have to take in relevancy of where these things are going to go. And what does this side of the market look like? The call side. But then, what does the put side look like? And here are various strike prices. So, when we take a look at shorter term cycles, such as August and September, as we take a look at it, where the capital markets are. And they're bullish. They have been. In an expansion cycle, as I said over here, none of these expansion cycles, and you're living in one right now, this one is current, these were also ones that you may have been involved in your lifetime, that everything looked good over here in the Bush administration. And that all failed. Back over here, the times were good. We came off of horrendous capitalism. Horrendous capitalism. Wow, what does that mean? Horrendous. Well, think about 1990 to 1996. Think about what was happening then. We finally got to the bottom, but it collapsed. It ended back where it all started. History repeated itself so mathematically, and so failure as it always does. You cannot hold the value when we get up here. We're going to break higher, and we're going to hit a certain plateau, as we always do. Short-term corrections is what they are in bull rallies. But when we look forward looking out is where does that mixed bear come into? So everything that governments are doing around the world is there's a consequence. And why is this 2-year expansion? 2009, 2010, and so far half of 2011. It's all part of the expansion. Just like it was over here in 2003. But they all failed. Now, what happens with the public is that they're not willing to deal with it because it's a hard thing to imagine that that's going to happen. What we're going to do is we're going to take that S&P 500 bull rally up to its top. There's a big obstacle. We know that the debt ceiling, we know that the manipulation there and all of this downgrade in our U.S. capitalism as we know it by Moody's and S&P. We also know that whether we pay our bills in the U.S. or not, we're going to pay them. They have to. However, the outcome is going to be different. And as we rally up to the tops of the S&P between now and year end of calendar 2011, is that if they do in the short term to stop those things, then of course we're going to rally back up. And we've been saying this about rallies all the way from the very bottom over here in 2009. We've been talking about this. We've been actually trading it, but we're going to rally up, and then it's going to fail. We're in a very long monthly buy signal on the S&P. That's why every dip is buyable. When you're in a sell signal, and the sell signals are that MACD reading. It's a public indicator. They only come around so often. Here, back in 96, you had a monthly buy signal. Look at it. It lasted all the way up until the top of this area in 2000. But then look at the monthly sell signal. The markets moved way down before they were actually created. Where in our system today, what we use in our system right here is that it tells us right away when these changes like this are happening. Okay, and this is a daily S&P 500, and when to go long here. And the thing about it is that's how markets are. And everybody wants a great outcome, except I don't see that. I don't see a great outcome when it's all said and done. And we're going to come back up here and we're going to challenge these highs. And in our system, when we take a look at the S&P, the monthly, our daily half bar is 1336. You can see how that dip came down and they came right back in up toward these tops. Now, when we look in our system, one thing that we're going to look at right now is how tops can play themselves out again. And when you take that top reversal and this top down reversal and this leverage up rally was great coming off that bottom, was also great going down, is that when we do get back up here in these areas, so let's take a look at it more in depth. Here you can see on a standard chart what it looks like is that we're going to have a big short that will come into play, and another one of these downside moves. And here's your upside rally. And it was much shorter in time than the longer correction that we called for here. S&P 500 is a special to know that you need to follow what we have to say. Not because we're better than anyone else, but we're accurate. And when we come back up here to that 1360 area in the S&P or slightly below it, we're going to be extremely overbought in a shorter term cycle. What does that look like? Right now, I show you here that you are 91%. That's a extreme bull on a monthly chart. As far as the strength of overbought, when we were overbought here, we're at 93.77, and I said we were coming down, and we did. And we got to the low point here. Like I said, the low point here, it wasn't much of a correction, for crying out loud, on a monthly chart. We've been elevated in an overbought zone in the whole calendar year of 2011. Mathematically, we have. And that means at some point there's going to be a major change. That change could happen right away, depending on what your government does for you. Okay? And how capitalism around the world is going to play. And why is the bond market the king forward looking? It is. I'm not going to go into the bond market. I'm just telling you. We're going to rally up and we're going to have another correction. We had 2 months of it right here in calendar 2011. That means that when we do come up, we're going to hit the wall of resistance. Right below 1400 is where we're going to be looking at. We're going to be looking at that 1360 that we called for because the earnings season wasn't going to be a collapse. It's just all about, you know, where's bottom line and top line growth. And this video is getting kind of long, so I'm going to have to conclude this at another date. But we're going to rally up, we're going to hit it, and we're going to reverse. And the next reversal that happens in 2011, as it will be greater reversal than this last 2-month reversal. This is how it starts. Then you come back up. This is the neckline, right below, way up here at 1399, 1467. 1450 could hit by year end, by calendar month of December 2011, if things went right. That's where the top end would go. But then again, if things don't go right, as they normally don't do, at some point they're not going to be right. So we're looking at how we bull rally up, but then when we get the next correction, it's going to be greater than this last correction right here. Okay? And we've had a couple of them. Big dip, big 2-month reversal, rising 10-month, bullish. Nothing bearish about it. However, as we lever back up, we're going to have another big pullback. Stay tuned.